So what we are going to do, we are going to look at the effect of fiscal policy on the level of economic activity. So again, in this chapter, we are trying to measure the effect of fiscal policy on the level of economic activity. So also we discussed this point in the first chapter. I remember this. We discussed the effect of fiscal policy on the level of economic activity in the first chapter. So during the pandemic, coronavirus pandemic, the pandemic led to precautionary measures, which led to recession. What is the recession? A decline in the level of economic activity. So we call the fiscal policy or the government to do something to stimulate, to encourage business sector to produce more. How? By increasing government expenditure and or decreasing taxes. This is what we studied in chapter 1. But here we will go to more details, to more in-depth quantitative analysis. And all the analysis will be built on what we discussed in chapter 7 about equilibrium. So we will start from a certain point, an equilibrium. So for example, in this year, we produced 500 billion dirhams, but still we are, even it is called equilibrium because aggregate expenditure equals aggregate output, but we are not satisfied with this level of equilibrium. We like more output to absorb unemployment. So we will take 3 kinds of multipliers. The first one called government spending multiplier. The second one is called tax multiplier. And the third one is called balance budget multiplier. So as usual, let me start with Farhane.
Yes, doctor.
Help me with this.
Yes, doctor. Fiscal policy, the government's spending and taxing policies.
Okay, so what is fiscal policy in Arabic? What is fiscal policy in Arabic? What's the meaning of fiscal policy in Arabic? Ali Hassan, Yusuf, Ahmed Muhammad al-Shihi. So I feel scared. So fiscal policy means in Arabic السياسة المالية. So in fiscal policy, we have 2 tools, or the government or the Ministry of Finance has 2 tools: government expenditure or government spending and taxes. Farhane.
Monetary policy, the behavior of the Federal Reserve Central Bank concerning the nation's money supply.
Okay, so the last chapter, chapter 9, will be about the monetary policy. What's the meaning of monetary policy in Arabic?
السياسة النقدية.
Yes, well done. Okay, so the monetary policy is implemented by the central bank behalf of the government, and it's related to increase or decrease the quantity of money supplied. So for example, during coronavirus, immediately the central bank took measures to increase the quantity of money supplied. Otherwise, we will lose the financial stability in the country. But immediately the central bank implements different tools, as we will see in chapter 9. So during recession, the central bank tries to increase the quantity of money supplied, but during expansion or inflation, the central bank tries to tighten or decrease the quantity of money supplied.
Discretionary fiscal policy, changes in taxes or spending that are the result of deliberate changes in government policy.
Oh, okay, so discretionary fiscal policy, estimated fiscal policy. So as you know, the Ministry of Finance or the government, it tries to build or estimate a public budget according to their expectation about the coming months. So, for example, because right now we are suffering from recession because of the pandemic, the government may design public budget on deficit from the beginning because they are willing to increase government expenditure and or decrease taxes. So by this public budget, we hope we will inject more money into the market, and that will stimulate the business sector to produce more and to hire more. So unemployment decreases, output increases. So we will rescue the level of economic activity. And I think also I need to explain public budget. So I need to explain something called public budget. You cannot see. So what is public budget? What is public budget?
Expenditure and revenue.
Yes, this is public budget. I don't know if I can. Okay, so this is public budget. So it's include two sides, expenditure and revenue. Revenues in most countries come from taxes. So assume our expenditure is 100 billion dirhams, and our revenues, we expect to collect data of 100. So in this case, the public budget is called balanced public budget because expenditures equals revenues. But sometimes the expenditure exceeds the revenue. The difference is 20. This 20 is called deficit. It's called deficit. What's the meaning of deficit?
عجز أو نقص.
Yes, this is deficit. So the public budget is in deficit. Why? Because we spend more than we earn or we collected. The difference between them is 20. So from where the government will get this 20, they will use their previous saving. So for example, in the United Arab Emirates, the Ministry of Finance has surplus in the previous years. They will use their savings, or they will borrow money from internal or external, from international banks or from general public in the country by issuing national bonds. Okay. And assume the expenditure is 80. So what we will have, so if the expenditure 80, and the revenues 100, there is a difference between them 20. The 20 is called surplus. So what's the meaning of surplus? Yes. So do you know during the years when the prices of oil were so high, so we collected money more than our need to spend, so we got surplus. So we invest this surplus abroad. And during years of deficit, we withdraw some money from our international investment or from our deposits in international banks. So this is 3 cases of public budget. So let's start from 100 to 100. So what I mean, during coronavirus pandemic, the government should increase government expenditure, for example, from 110 and or decrease taxes to 90, for example. In this case, we will have a 20, which is called deficit. So now my advice is to increase government expenditure and or decrease taxes, and the public budget will be designed on deficit. So there is one question in chapter 1, we discussed it before. We explained these concepts. Okay, let's go further. Where is Farhane?
Yes, doctor.
Farhane, during this semester you will fail.
Why, doctor?
Because you couldn't read one slide.
Doctor, you were explaining. How should I read?
Just read. Stop me and read.
No, I can't stop you.
Okay, go ahead. Thanks a lot.
Government purchases G, net taxes T, and disposable income YD.
Okay, so see here, we will use these symbols G, T, Y, D in our coming model. So keep these terms in your mind. So we use G to represent government purchases, government expenditures, government spending, government consumption, and gross investment. So we refer it as G. So we use now T to refer to net taxes. What is net taxes? We will explain it soon. And now, before in chapter 7, we use Y. Y, aggregate income or aggregate output. Now, because the government imposes taxes, or we will add taxes to our model, so we have to use another term called disposable income. What is disposable income? Income minus taxes. Okay. Farhana.
Net taxes T, taxes paid by firms and households to the government minus transfer payments made to households by the government.
Okay, so what is net taxes? The net amount collected by the government. So we will deduct transfer payments. It is a sort of gift to or financial aids to weak people. So anyhow, net taxes, net amount collected by the government. Farhane.
Disposable or after tax income YD, total income minus taxes Y minus T.
Okay, so now disposable income YD equals by definition total income minus taxes. So here these terms are quite simple, easier than what we explained in chapter chapter 2 about national accounts. But why I simplify the concepts? Because I need to build a simple model. So we are going to build a simple model, but it is a bit more complicated than the model we discussed in the previous chapter. Okay. Thank you, Farhane. Let's go to Lana. Lana, could you help me?
Yes, doctor. Government and the economy. Government purchases G, net taxes T, and disposable income YD. When government enters the picture, the aggregate income identity gets cut into 3 pieces. Shall I continue?
Yeah, no, thank you. So see here, what we did in this slide, we add the government to our model. If you remember, in the previous chapter, I used to say we live in a small village in which there is no government, no interaction with abroad. So planned aggregate expenditure equals consumption plus planned investment. So now we will add the government to the model or to the picture. So there is something slight changes. So what is disposable income? Income minus taxes. So what is disposable income? Income minus taxes in very easy way. I will even not use net taxes, I will say taxes. So disposable income can be allocated between consumption and saving. See here, before we say income allocated between consumption and saving because there is no taxes. So now we have to consider taxes. So what left, which is called disposable income, allocated between consumption and taxes. So see here, YD equals Y minus T. Disposable income equals Y minus D. While this is the allocation of disposable income, C plus S. So I will shift T to another side. So see here, Y, which is aggregate income. So again, this is aggregate income or aggregate output. By definition, this is the allocation of income, consumption plus saving plus taxes. What is the component of aggregate expenditure? Consumption, planned investment, and government expenditure. So Y, aggregate output, this is allocation of money, allocation of resources. So by definition, so if the United Arab Emirates got 500 million dirhams as income, they will allocate the income between consumption, saving, and taxes by definition. So it is always equal. Y always equal to these 3 terms. Aggregate expenditure, this is the component of aggregate expenditure. Still, just okay. I don't know whether you are hearing my baby is making noise. I'm sorry for that. So aggregate expenditure equals consumption, planned investment, government expenditure. What is missing here? Net export. Yeah, because here in this model, we assume our country is closed. There is no interaction with abroad. If you stay with me for next semester, I will give you a new model and I will add the international sector. So the model will be much more complicated than this. So now I think you understand how to analyze economically. So in economics, we try to simplify the phenomena to get clear results or clear conclusions. So in equilibrium, we need equality. In equilibrium, we need aggregate output to equal planned aggregate expenditure. So equilibrium can be reached when aggregate output equals planned aggregate expenditure. If Y is more or less than planned aggregate expenditure, we will be at disequilibrium. So what is Lana?
Budget deficit, the difference between what a government spends and what it collects in taxes in a given period, G minus T.
Okay, so government spending minus taxes. If the government spending is more than taxes, for example, 110 minus 90, so the deficit will be 20. The deficit will be 20. Why? Because we spent 110, but we collected taxes of 90. So public budget will be on deficit. It is called budget deficit. عجز الموازنة. So we can collect deficit or surplus according to this equation. So if the government spending less than taxes, we will enjoy surplus. So what I said during the period when prices of oil were so high, so for example, we collected 100 and we spent 80, so we will have surplus of 20. This slide is quite simple, but it's important. It's important because from now and for the final exam, you will see YD. I'm sure in the final exam, you will see YD, which is disposable income. I'm sure. I will insert a question related to YD. So thank you, Lana. Ahmed Muhammad al-Shahi. عليا حسن.
Yes, doctor.
عالية كيف حالك؟
الحمد لله.
شلون البيبي؟
الحمد لله بخير.
الحمد لله. الله يسعدك إن شاء الله ودائما إن شاء الله بخير.
إن شاء الله وياك دكتور.
الله يخليكي. يلا بابا ساعديني.
A government purchases G, net taxes T, and disposable income YD, adding taxes to the consumption function. To modify our aggregate consumption function to incorporate a disposable income instead of before tax income, instead of C equal A plus BY, we write C equal A plus BYD.
So now we used to, in the previous chapter or in the Keynesian theory and then in the equilibrium, we used to write consumption function as C equals A plus BY. Now, since the government is part of the model, so instead of Y, we will use YD. So we will use YD, disposable income. What is YD? YD equal Y minus T. So from now, I will give you consumption function with YD. Alia.
Our consumption function now has consumption depending on disposable income instead of before tax income. Okay,
so now consumption is a function of or depends on disposable income. This is very simplification when I say C is a function of Y. It is more practical to say C depends on disposable income. Okay, so for Ali Hassan.
Yes, doctor. Planned investment, the government can affect investment behavior through its tax policies. We continue to assume that planned investment I is fixed.
Okay, so do you know the planned investment or investment itself is a complicated matter, and I don't know whether I told you I have a paper about determinants of private investment in the United Arab Emirates, and you can check my paper in my personal website. But to simplify our analysis, we still assume planned investment is fixed. Assume that business sector decided to invest 25 billion dirhams regardless of the level of economic activity. This is much simplification of the phenomena. Why we use this very simple hypothesis to facilitate building simple model, and simplification will help us to get good conclusions or results. So if you understand this slide, almost we finished our meeting today. Okay, so don't get scared. So equilibrium can be reached when aggregate output equals planned aggregate expenditure. So what are the components of planned aggregate expenditure? C plus I plus G, because we add the government. Okay, so this consumption function is important. Oh, the consumption function equals C equals 100 plus dot 75 YD. It is not Y, it is YD. Okay. So I'm trying to bring your legs into the table to get in-depth understanding of the whole story. So we will start with different level of aggregate output. So I will give you these different level of aggregate output. Assume taxes is determined by the government at 100, regardless of the level of economic activity. So net taxes, T, is fixed at 100. So then we can collect disposable income. Disposable income equals Y minus T. So 300 minus 100 equals 200. So this is disposable income. Disposable income is less than income by taxes. Okay. So use this consumption function to calculate different level of consumption at this level of income. Okay. So let me start working with the first point. So if disposable income 200, so I will put here 200. 200 times dot 75 will be 150 plus 100, 250. Is it clear? Hopefully it's clear. Hopefully it's clear. So for example, disposable income 1,000. What will be the consumption? So 1,000 times dot 75 will be 750 plus 100, 850. So we calculated different level of consumption. What is saving? Saving equals disposable income minus consumption. Saving equals disposable income minus consumption. So for example, let's see disposable income 800 minus consumption 700. So we will get saving at 100. Okay, a planned investment, assume planned investment is fixed at 100, regardless of the level of economic activity. Government purchases or government expenditure is fixed at 100, regardless of the level of economic activity. Now, calculate a planned aggregate expenditure. What are the components of a planned aggregate expenditure? C plus I plus G. So I will calculate it for the first point. What is the planned aggregate expenditure at level of aggregate income 300? So let me look for consumption. Consumption 250. I will write on piece of paper in front of me. Consumption is 100. Investment 100. Government expenditure 100. So 250 plus 100 plus 100 equals
450.
450. Let me calculate at aggregate output of 900. What is planned aggregate expenditure? Consumption 700, investment 100, government expenditure 100. So planned aggregate expenditure will be 900. So we understand how to calculate this. Okay. So we need now to take a level of aggregate income or aggregate output at 500. Now look at this equation, or even at this simple equation. Aggregate output equals planned aggregate expenditure, we will reach equilibrium. Otherwise, we will be at disequilibrium. So let's see whether 500 aggregate output will fulfill the condition of equilibrium. So at 500, a planned aggregate expenditure is 600. See here, demand is 600, supply 500. We produce 500, but we sell 600. What will happen to business inventory? So since we sell more than what we produce, business inventory will decrease by 100. Use this equation, Y minus aggregate expenditure. So 500 minus 600 equals minus 100. This is called unplanned decrease in inventory. By next year, business sector will react by increasing output. Why business sector will increase output? Because demand is higher than supply. Demand is more than business sector expectation. Their expectation is 500. They expect demand will be 500. For this reason, they produce 500. So aggregate output will increase till we reach 900. Let's take another example at 1,300. What is planned aggregate expenditure? 1,200. So we produce 1,300, but we sell less. What will happen to business inventory? Y 1,300 minus planned aggregate expenditure equals any planned change in inventory. So business inventory will increase by 100. Why? Because demand represented by planned aggregate expenditure is less than supply represented by aggregate output. Business sector will react by decreasing output till we reach equilibrium. At 900, aggregate output equals planned aggregate expenditure. There will be no need to change the business inventory, and we will enjoy equilibrium. Is it clear till this moment? Hopefully it's clear. So when we add the government expenditure, also we will enjoy equilibrium. Okay, so this is, so there is nothing new here. Okay. Thank you, Alia Hassan. Raja. Raja, assalamu alaikum.
عليكم السلام دكتور.
Could you read this for me?
Okay. Finding aquarium output income
Graphically.
Okay.
Graphically. Okay, go ahead.
Because G and I are both fixed at 100, the aggregate expenditure function is the new computation function displays upward by I plus G equal to 100. Aquarium across at Y equals C plus I plus G equal 900.
Well done. So this is consumption function, the straight line blue curve. And because I will add investment and government expenditure, each one equals 100. So I will drag the curve upward and I will keep the vertical distance equals to 200. So the dark red curve is called a planned aggregate expenditure. This is 45-degree line. The intersection point between 45-degree line and the planned aggregate expenditure refers to equilibrium point. At this dot, aggregate output 900 equals planned aggregate expenditure 900. So if we select, for example, at 600, planned aggregate expenditure is more than aggregate output, the vertical distance refers to any planned decrease in inventory. Business sector will react by increasing output. At 1,300, aggregate output is more than planned aggregate expenditure. Supply is more than demand. The vertical distance refers to any planned increase in inventory. Why? Because we produce more than we sell. So business sector will react by decreasing output. Hopefully you understand what I explained till this moment. Do you have a question till this moment? There is another approach to discuss equilibrium. So leakage equals injections. So this is called saving investment approach, but we explain saving investment approach in chapter 7, but here we will add the government. So also leakage equals injections. So what is leakage? Part of income, part of Y doesn't go directly to purchase goods produced domestically. So saving and taxes. Money comes from Y, from our income, but it doesn't go directly to purchase goods produced domestically. Injections, money spent in our country to purchase goods produced domestically. So business sector will invest money to expand their project. They will purchase machines and housing units. So they will stimulate the economic activity. This G, government expenditure, when the government spend money, they will purchase goods produced domestically. It will activate the market. So again, there is nothing new. I said the allocation of aggregate income between consumption, saving, and taxes. and aggregate expenditure in our model equals consumption, investment, and government expenditure. So we can delete C from both sides. So equilibrium can be reached when saving and taxes equals investment and government expenditure. See here in the previous chapter, we used to say equilibrium can be reached when saving equals investment. But now we add taxes and government expenditure. Keep in your mind, it's not necessarily here for saving to be equal to investment to reach equilibrium. What's important, the left side should be equal to the right side. So the sum of saving and taxes should equal investment and government expenditure. But it's not necessarily for taxes to equal government expenditure. Maybe there is more or less. But the left side should equal to the right side. So this topic, we have 3 multipliers. I guess you understood the concept of multiplier from the previous chapter.